everybody, Luke Gromen, FFTT. Hope everybody had a great weekend. Before we jump on into the two things that grabbed my attention recently, I'm going to read out just a quick testimonial about tree rings. Morning, Luke. I'm blown away again. Nothing opens my eyes more to the complete global picture better than the tree rings do. It gives me confidence that I'm on the correct path to help my clients survive what is coming. Thank you. It's from our friend Bruce, who's a tree ring subscriber, has been for a long time. Love getting that kind of feedback. So with that, we're going to jump right into the two things that grabbed my attention recently. The first was the notation that 51% of this year's ETF inflows have gone into fixed income ETFs. Thought that was interesting. Point number two. Central banks have been buying nearly 20% of the world's gold supply, approaching the highest levels since the Nixon era, as compared to being net sellers from 1971 through 2010. And then the last thing, tying the two together, it came out Friday evening that U.S. wage growth surpassed mortgage rates for the first time since 1972. Buying bonds when wage growth is above mortgage rates? Not a great idea. That's not how you make money. You can make money nominally, but you're going to go from, you'll go from wearing diamonds to wearing cubic zirconia to wearing Cracker Jacks on a string over time. So it's interesting because when this happened last time in 1972, gold rose 50% in 1972. It proceeded to rise 18-fold over the next 8 years. So the bottom line is I think there's something very interesting happening. And you're seeing central banks do one thing that aligns with that, and you're seeing the crowd do something different that is not what you want to be doing historically when that happens. So I'm going to jump into a few questions here. First off, from MH, what is your number one tell to look for that the market has sniffed out that the entity the Fed is financing or bailing out via the repo programs is the U.S. government and financing U.S. deficits? To me, it's going to be more of a process than a single tell, but I think we've already started to see it, right, in terms of the shift from this is temporary to this is not temporary to this is not QE. I think we will start to get, once we get on the other side of New Year, my suspicion is that unless the dollar weakens markedly, you're going to see the Fed repo programs continue longer than expected, probably continue to grow, and you'll see the balance sheet continue to grow in all likelihood. And if you see that, or regulatory changes that accomplish the same thing, at some point on that process, like I said, it's a process, people that have been apologizing or apologists for what the Fed has done are going to be forced to say, all right, look, this isn't temporary. And gosh, say what a number of others have said, including ourselves, is, gosh, this looks an awful lot like the Fed's financing the government. I don't think it's ever going to stop. So that would be, our tell. It's more a process than a single event in our view. Let's see, from Eric, what do regular non-financial people do with our investments during such times of volatility and risk? To me, I think you just need to be diversified. I think if you don't own some physical gold, I think you need to own probably 5 to 10% of your net worth in physical gold. Look, central banks are doing it. The Basel III regulations have blessed it as a 0% risk-weighted asset under certain circumstances. And then I think you want to be diversified equities. You probably want to own a little bit of bonds. For me, I want to be underweight bonds, and that's a personal decision depending on age and financial situation. So, and how much income you need versus, longer term growth. But consult your financial advisor on that. Let's see. People underestimate the power the elite of the Western world have in keeping this status quo monetary system in place and alive for as long as possible. If or when it fails, what are your thoughts on their political or military motivation or might to resist Austrian fundamentals? To me, the key, not the key, but maybe the most interesting thing about the dynamics that have unfolded is that are unfolding still, is that it is actually in the interest of the status quo for this system to change. The United States DOD, certain interests in Washington actually are seeing that the exorbitant privilege of the dollar has become an exorbitant burden. You're seeing a number of different creditor nations move and take steps to move away from the system. So it's actually in most elite / policymakers' interest to move away from the system, and that's why I think we're seeing the moves we are. That said, there are those that very much like and want that status quo to stay in place, and so I think that is being reflected in some of the geopolitical market tensions we're seeing. Okay, so let's see here from Darren. Can you clarify when you say that the dollar may weaken, are you talking against other fiat currencies or are you talking against an anchor like gold, for example? To me, the easiest trade is dollar against gold when you talk about what will the dollar weaken against. But I think it will over time also weaken against all the other fiat currencies simply because if we're moving towards a more multipolar system, which the evidence suggests we are, that is going to force the system back towards being a more balance of payment centric system. And that's the way the world worked for pretty much most of economic history up until 1971. And so if you're going to be a more balance of payment centric system, the United States dollar is the weakest or the dirtiest dirty shirt. Either it or the British pound are the two dirtiest dirty shirts in the SDR basket. I would expect them to weaken against the yen. I would also expect them to weaken against the euro and the yuan within the SDR basket. Final question from Miad. Where are yields headed on the 10-year? Great question. To me, I think 10-year yields probably bottomed earlier this summer when you saw the yield get down to wherever it was. I think 1.5. I think that was the bottom. And the reason I say that is you start seeing things like we're going to see more headlines like wages are above mortgage rates. I'm not buying 10 years with wages above mortgage rates. That's crazy. And understanding that, yes, you could see the economy weaken, but that ties back into this point of what the Fed is doing in terms of needing to help finance U.S. deficits. I think we're just in a very different time we haven't seen in 50 years, maybe 100 years. And so, to me, I think the 10-year. I think we've seen the lows on the 10-year. The bigger picture, though, is I think the yield curve will be made to do whatever it needs to do for the Fed, for whatever political expedience it needs to be. And by that I mean last time the world was in this position, the Fed pinned short-term yields, they pinned medium, the belly of the curve, and they pinned the 10-year. And this was during World War II when U.S. debts were high and foreigners were not buying our treasuries for obvious reasons. And so it was a Frankenstein curve. It was positively sloped, 3/8, 7/8, 2.5. Fed would buy anything you sold at those prices, near, belly, far, long end, and that was the yield curve. And so everyone got paid their coupon, and the rates were tremendously negative. And so I think we're moving towards a negative real rate, an increasingly negative real rate regime, where the yield curve's not going to really tell us anything. It's going to tell us what the Fed wants it to tell us. So that is all we're going to touch on tonight. As we said earlier, check out Tree Rings and look forward to catching up with you guys soon. Hope everybody has a great week. Take care, everybody.